Welcome to Week 1 Finance and Investment. This week's learning objectives will be to examine the current financial position of a corporation and to understand and analyze a corporation's public financial statements. The U.S. Securities and Exchange Commission defines an annual report as a document used by most public companies to disclose corporate information to their shareholders. It is usually a state of the company report, including an opening letter from the Chief Executive Officer, financial data, results of operations, market segment information, new product plans, subsidiary activities, and research and development activities on future programs. Reporting companies must send annual reports to their shareholders when they hold annual meetings to elect directors. An examination of the financial position of an organization requires a review and summarization of the relevant aspects of the annual report, including the balance sheet, the income statement, the statement of cash flows, and the statement of stockholder equity. The first financial statement we're going to look at is the balance sheet. And the balance sheet is a statement of a firm's financial position at a specific point in time. It's important to note that balance sheets represent only a snapshot of time. They allow us to identify net working capital, and they also allow us to identify net operating working capital. Here's an example of a basic balance sheet. On the left-hand side, we have current assets, which are things like cash, inventory, and accounts receivable. And we need to add them to our fixed assets, which are our equipment, our facilities, and our plant. When added together, these represent our total assets. On the right-hand side of our balance sheet, we have current liabilities, which are things like accounts payable, payroll, and taxes. In addition, we have to add in our long-term debt and our stockholder equity. These things combined equal our total liabilities. For our balance sheet to balance, our total assets must equal our total liabilities. The second financial statement we're going to look at is the income statement. And the income statement is a summary of an organization's revenue, expenses, and profit over a given reporting cycle. Things to note. When looking at an income statement, we want to identify the impact of debt versus equity on net income. It's important to realize that debt reduces net income, and this could influence equity or debt decisions. Also, earnings from operations before interest and taxes is another key thing that we want to look at when reviewing the income statement. Other key takeaways from the income statement are earnings per share, also known as EPS, dividends per share, known as DPS, and book value per share, known as BVPS. Of these metrics, one of the most important ones is EPS for stockholders, as this is known as the bottom line, and it denotes all of the items on the income statement. The third financial document we will look at today is the statement of cash flows. The statement of cash flows is a summary of items that impact both the balance sheet and income statement, which have an effect on a given organization's cash flow. In other words, a cash flow statement shows how much cash a firm is actually generating. When looking at a statement of cash flows, it's important to be able to identify positive or negative cash flows, to be able to identify the relationship between fixed assets and depreciation, to have a good understanding of dividends, and understand how the cash balance from year start to year end works. Components of a cash flow statement include operating activities. These convert the items reported on the income statement from the accrual basis of accounting to cash. Investing activities, which report the purchase and sale of long-term investments in property, plant, and equipment. Financial activities, which report the issuance and repurchase of the company's own bonds and stock, as well as the payments of dividends. And supplemental information, which reports the exchange of significant items that did not involve cash and reports the amount of income taxes paid and interest paid. The fourth and final financial document we will look at is the statement of stockholder equity. The statement of stockholder equity identifies and summarizes the changes in an organization's equity for a given reporting period. One of the key takeaways of interpreting a stockholder equity report is the ability to determine the amount of retained earnings reinvested in the business. Stockholder equity is a representation of the capital that an organization has received from investors in exchange for stock. When looking at all of the different components, if we take total assets and subtract total liabilities, we should have stockholder equity. But what is retained earnings? Retained earnings refer to the percentage of net earnings not paid out as dividends, but retained by the company to be reinvested in its core business or to pay down debt. It is recorded under shareholders' equity on the balance sheet. The formula calculates retained earnings by adding net income to or subtracting any net losses from beginning retained earnings and subtracting any dividends paid to shareholders. Once we have reviewed the financial documents, it's important to be able to analyze them. Financial statements are necessary for tax purposes, but they are also beneficial for managers and potential investors. By analyzing the data in these statements, we can derive potential indicators of current and future success or problems. Some key examples of these derived values include free cash flow, market value added, and economic value added. For additional information on any of the topics covered, please see these references. In addition to these references, Khan Academy provides excellent tutorials on interpreting and understanding any of these financial documents. Thank you.